On the show today, we'll assess Nigeria's oil-driven rebound. As always, you can join the conversation with the hashtag Beyond Markets, and you can follow my Twitter handle too at Esther Obudaga. Now, Moody's Investor Service says Nigeria's rebound in growth, which was primarily driven by oil, could last to at least 2019 to support the credit profiles of the country's banks, companies, and regional governments. However, the recovery will remain modest and fiscal pressures will persist. Aurelien Mali, VP and Senior Credit Officer at Moody's Investor Service, joins me now to discuss this. Thank you, Aurelien. It's a pleasure to have you in the studio with us today.
Hello.
Quite a comprehensive report on the Nigerian economy, and you did cite some bright spots, some challenges for the economy, especially for the economic recovery. And the first that you point to is the weak growth in non-oil revenues, tax specifically. Could you speak to that point?
Yes. In fact, the recovery of the oil sector is structural, but it supports the economic growth directly and indirectly because it improves also dollar liquidity and government revenue, as more than 50% of governments are oil related. But it still compensates only partially the shortfall in the targets for non-oil taxes at the government budget, within the government budget. And therefore, you have still an even larger dependence on oil price and oil revenue for government. And one lesson that was learned from the oil shock over the last few years is that it exposed vulnerabilities within the credit profile for Nigeria, for the sovereign, where we saw the level of revenue falling to close to 5% of GDP in 2016, which is the lowest in the all-rated universe that we have at Moody's, more than 120 sovereigns. And therefore, it exacerbated as well the fiscal ratios of the government, such as debt over revenue, that now is more than 3 times in terms of ratio. The debt service, interest to revenue, that is for general government, that from below 10% now is at 30%. And therefore, one of the long-term constraints is this inability for the government to really increase the non-oil tax to shelter the revenue of the government from oil price volatility. So things are improving, but it's mainly due to the rebound in oil price and oil production.
Now, I was going to take you up on that. I'd like to hear your thoughts. Back in 2014, when we saw that significant dip in oil prices and the economy was basically in trouble. And, the authorities came out and were like, you know what, we're going to embark on this diversification drive to diversify the economy, focus on sectors that will bring us quick growth, especially agriculture. Mm-hmm. So it would appear that there was that gusto, drive, significant drive toward that path. And we are still on that path, but in your opinion, would you say that because along the line we began to see that significant rebound in oil prices, we lost some of that steam? Because right now, as we speak, if we take away oil and higher oil prices, what would we be saying about the Nigerian economy today?
No, that's clear. The diversification for all oil, large oil exporter is key on the agenda, but it's very difficult to do. In the case of Nigeria, keep in mind that the oil sector is only 10% of GDP. The economy is diversified. It's more the exports that are 90% plus oil and gas. And therefore, the key for at least over the medium term, when the government talk about diversification, is the diversification of their revenue, the sources of their revenue, so that they will be able to better implement, for example, capital spending, increase infrastructure development spending, and also improve over the medium term the growth of the country. I just want to come back on this idea that effectively the growth and economic and recovery plan really put the diversification effort as well on the agenda. But it's more to say that the authorities would like to see more investment creating job and production capacity within Nigeria. So one of the policy tools that they use is these capital controls that prevent some economic agent within Nigeria to use dollars through official channels to import some items. So that creates opportunities for Nigerian entrepreneurs or for foreign investor to create the production of these items in Nigeria. So we see already some corporates trying to source the input for their production in Nigeria because they cannot access dollars through official channels to import what they need. But it takes time to really be implemented and really create growth and jobs and the production capacity that they want. But at least they're determined to maintain it. That affects as well this structural change, the service sector that is not rebounding as or growing as it was in the past.
So are you saying that there is enough, Moody's sees enough political will to drive the recovery?
So what we see right now is a determination to still change the way the economy was doing before, the structure of the economy. Before, you had a lot of trade related to somebody importing something in Nigeria and at the end extracting a portion of the oil rent. Now what they want is real FDI that will create jobs. But during that moment, it's very painful. Some companies have closed. Some business are not sustainable because they don't have access to dollar. And the central bank, despite having more dollar now in its vault, is still suppressing some of the import and rationing the demand for dollars within the economy with these capital controls.
That being said, sometimes when a major turnaround is needed, it could be in a company, a corporate, or a country, sometimes it is said that it is the strength of the strategy that could make all the difference, even though time is needed for that strategy to have the desired impact. Where I'm going with this is Nigeria's tax drive, the drive to increase taxes. We're still at 6% tax to GDP ratio. That's still very low. I know that a lot of things have been done to increase widen the tax brackets and get people to just basically pay their taxes. There's evades on one hand for the wealthy, and the tax laws have also been tweaked to get. But I'm just wondering that it doesn't appear that there is momentum.
Yeah,
so is it a strategy problem? I mean, you're aware of the tax strategy. What do you think about it?
So we cannot give advice to the government because we cannot be judge and parties. We have a B2 rating. We downgraded the country last quarter in 2017, and it was exactly because of this the effort to raise non-oil taxes that are commendable. They still grew by 18% last year. But it was below nominal GDP. So as a share of GDP, it was still lower than the year before. This year, it will improve. It might go up till between 7 and 8%, but it's on the back of much higher oil price than budgeted. That will mean that, again, oil revenue will compensate the shortfall. But the inherent vulnerability are still there. And this recovery that we see, we are a bit more positive than the consensus for this year at 2.8% of GDP is really driven by, we expect a bit more growth in the service sector, that is half of GDP. But this overall, if you want, slow recovery, because it's still not enough to really improve the living standard of Nigeria, 2.8% of GDP. But it's still fragile. It's based on oil price. It's based on, especially for the external side, on portfolio inflows that are volatile, on borrowing by the government, the issuance of Eurobond, and there is a limit for the issuance of the government in terms of external debt, because the debt is already 20% of GDP. It's not a lot by peer comparison, but it's a lot in terms of weight compared to the revenue the government has. So there is a limit. They won't be able to issue 7.3 billion every over 18 months for a long period. And also remember that imports are compressed. They are compressed by the capital control. So this is an environment that is still fragile. It's not, the reserves are not accumulated surplus through the excess crude account. In that case, that will allow the government to be certain to implement the capital spending, for example.
Around the issue of debt, now I'm sure you're aware of what the government is doing, you know, slowing, cutting back on domestic debt in favor of foreign debt. I mean, in terms of for both of them, ceilings, I mean, like you said, they're not too high compared to our peers. Some alarms have been raised about, you know, the pace at which, you know, we're issuing euro bonds. But I'm thinking, I mean, that's still a good thing. I mean, slowing down on domestic debt participation, allowing for the corporates to come in and also, you know, issue bonds. But what are your thoughts on this strategy of the federal government?
So the strategy of the public debt was very clearly explained in the document of the Debt Management Office, which was clearly to increase the external debt in the structure of the debt of the government, so that it is long maturities, and we saw that Nigeria was able to issue at 30 years, and also to lower the cost, because of course the external debt is less expensive than at that time the very costly T-bills that were in terms of liquidity risk rolled over quite frequently. That being said, for us, for a credit agency like Moody's, we see also the risk by having a larger external debt, because you then take a potential exchange rate risk for the future. Everybody has had to experience the devaluation of the Naira, but when you have to reimburse dollars, you have to make sure that you will have the resources. At the end of the day, the debt level at this current stage is not yet worrisome. Is the accumulation, the pace of accumulation that was at least highlighted by us, because when you have 3-4% of GDP deficit because you have an external shock, it's not that high. But it's high for Nigeria because it's close to 50% of its revenue. So it's like you spent 50% more than what you earn. You cannot do that for a long period before entering into some difficulties, or at least some question from the market. So the strategy is saving a lot of money for the government in terms of...
in the short to
yes,
medium term.
But doesn't mean that we don't see a certain risk that is building over the medium to long term if, in particular, the government is not able to raise its resources, own domestic resources, and if there is another shock, because when you look over a long period at oil price, it's just moving very high, volatile, very low.
Hopefully the government is aware of this. So, Aurelien, we'll take a quick break. Thank you for your time so far. We'll come back and pick up from where we left off. I've been speaking to Aurelien Mali, Vice President and Senior Credit Officer at Moody's Investor Service. Still with me in the studio is Aurelien Mali, Vice President and Senior Credit Officer at Moody's Investor Service, and we're assessing Nigeria's oil-driven economic rebound. Thank you so much, Aurelien, for your time so far. Let's go deeper into your latest report on Nigeria's economic situation, as it were. Talk us through what you see, what you think are still some of the key highlights.
So what we wanted to highlight is that there is a fragility in this recovery that is really supported by the oil sector, but also that the growth is still slow at 2.8% and is uneven. This is important. We still think agriculture is doing well. Manufacturing is going to pick up a bit. You have, of course, the service sector, which is key, that we are a bit more positive than the consensus. But an important element that we stress in this report is that the oil sector for us has structurally improved over the last few years. It was one of the key pillars of President Buhari campaign, and it's important to note that there has been no cash calls arrears in 2017, which means that IOCs, international oil companies, and other stakeholders in the oil sector in Nigeria are ready to further invest. And therefore, it's very important because then the assumption that the oil production will average 2.3 million barrels per day with condensate over the next few years is credible. It's possible to do that. Before, we were really wondering if it's going to happen because with the militancy, the attacks.
I was going to ask you, are you taking into account the possible, the risk that still remains to oil production?
It's there. Definitely it's there, but with the agreement signed, we have 18 months now. It's still working relatively well. There could be some attacks, but we don't expect the disruption that you had in 2016. So the oil sector, it's also the transparency, the reform of the NNPC, the PIB bills, which one part is already passed through Parliament. So you have a number of elements that says, yes, the sector is improving. There is still a very important piece of legislation, which is the framework for investment in the offshore fields. So that will be very also high on the agenda of the authorities because it's key for moving up the level of production. So there is that. There is also an element that we wanted to stress in the report is that there has been slight improvement in the doing business indicators and also in terms of voice and accountability on the worldwide governance indicator, which means that the fight against corruption that is relatively long, I would say, effort for Nigerians, there is still a small inflection point here that is signaled by different surveys. That being said, the institutional strength in Nigeria is still a key constraint, a long-term constraint on the rating. It's still evidenced by, for example, the fact that in May 2018, the 2018 budget is still not passed.
How big a concern is that for you?
You know, now it's difficult to reconcile numbers because you have capital spending that is on a rolling 12 months. So spending on capital project by the government in May are still on the 2017 budget, while current expenditure like salaries are from January to December.
So it's 2017 all over again. And I think it's actually easy from where we're sitting to predict how this year is going to go too. And I'm thinking that is something you also have to take into consideration.
We take everything into consideration, but on the public finance, it's clear that there has been a weakening over the last few years, and it's reflected by our rating as well, that move down. We used to assess the financial strength of Nigeria at very high. At that time, you had only 1% deficit, and you accumulated fiscal surpluses in the reserve, in the excess crude account, but it was depleted. And when the crisis occurred, there was no financial assets to shelter government spending, and so the adjustment was much more difficult and painful for the Nigerians and the economy.
So let's talk about the banks. So we'll come back to the sovereign, public spending. You say this is, your report says that the recovery is a credit positive for banks. Give us more insight in that.
No, definitely when you have positive growth and you have improved external liquidity because of the large oil sector, the banks are exposed to the oil sector. It's positive for the banks, but it's a slow recovery. So there are still a lot of areas to be cleared, in particular at the state and local government level. So they are there. We expect that they are not going to crystallize because right now you have an excess price, a positive difference between the budgeted oil price and the international oil price. So in theory, you should have accumulation in the excess accrued account. But as you know, it follows the distribution formula, so it is likely that the state and municipality are drawing down on this just to clear the areas that have accumulated. So it will take probably several quarters if oil price remain high to clear these areas. So we don't expect this to affect the bank too much. Now, also what is important to signal is that the externalization of the debt of the government means that the banks are going to earn less on the yield on domestic T-bills.
Coupled with the FIRS 9 that they've had to make, future provisioning for, whatever loss on, loans that they incur.
Yes. So that will probably be a kind of moment of truth. We'll see that in the numbers, but they will have to probably modify a bit their model, because their net interest margin is going to suffer from the lower yield and less debt instrument on the market. So they will have to lend more to the real economy to find Nigerian entrepreneurs that are...
That is one conversation I've been having with bank CEOs. I keep asking them, the bank's intermediation role, to the economy. Many of them say that, okay, we're going to lend more to agriculture, manufacturing, but we don't exactly see that coming. Well, they are doing that, but the numbers are quite low. And I'm thinking, to what extent do you think these banks are going to support the economy this year? I mean, they're also maybe not in a very vulnerable position, but the risks and the shocks are there for the banks themselves to deal with. So I'm thinking, adding that to how they should support the real sector.
That's only time will tell, really. But I think they have no choice if effectively the domestic capital market is reducing. They will have to invest their resources somewhere, and so they will need to develop more the risk management in terms of understanding the businesses and the risks they take in lending to the private sector. But otherwise, their margin and profit will probably be affected.
So going back to the sovereign spending, we're seeing, the budget we're hoping the budget will be passed, and at least we moved up to 30% capital expenditure, but then there's always that issue of, at the end of the year, how much of that 30% was actually spent on capital and how long it took for those disbursements to take place. But what are your thoughts in terms of how that is going to play out this year? Money is going into infrastructure projects.
That's a very, this is the key of long-term development for Nigeria, the ability to develop the infrastructure needed for the economy. So capital spending by the government is leading the way to increase the investment in the sector. That being said, is that if you look at what has been achieved in terms of realization rate for the capital spending over the last few years, it has been quite low. It improved a bit compared to 2014-15, but we are still at 50% spending rate compared to the level announced. And also, it's to avoid larger deficit. You know that there is a fiscal act at 3%, which in a sense it's positive when you look at credit quality like we do. But so it circles back to the one of the key constraints on the rating is the level of resources and the non-oil taxes. It's the lowest in the world, 3.5% of GDP for non-oil taxes. You know, when you look at peer countries in the region, for example, Kenya is B2 rated by Moody's, or even Angola, that is one notch below, also a large oil exporter. They managed to raise close to 10% of GDP of non-oil taxes.
What lessons can Nigeria learn from a country like that?
I mean, it's not just from this country.
You're satisfied with the level of, political will, although you like to term it differently, but what can we learn?
Let's put it this way. All the countries that we rate are able to raise more taxes on the non-oil economy. The non-oil economy is 90% of GDP in Nigeria. So, but just mentioning on the capital spending, going back to that, we did the first green bond assessment of Nigeria, specifically targeting a capital spending project like power for university, and we assessed it at GB1, which is the highest level in terms of implementation, monitoring, that this CapEx, capital expenditure, is targeting capital project. And so it's also interesting because as we have concern on the institutions, the design of this bond
that are project specific
was very, very well designed, and we felt comfortable enough to assign the highest assessment for green bond. It was issued in local currency in the domestic capital market, and there should be more coming in the next quarters.
Okay. Aurelien, we're going to have to leave it there. Thank you so much for talking to us today. Pleasure having you.
Thank you.
On the show today. I've been speaking to Aurelien Mali, Vice President and Senior Credit Officer at Moody's Investors Service.